Good afternoon. My name is Kathy Macbeth, and welcome to Eco Insights. Today's topic at Eco Insights is finance, funding, lending, and loans for bioenergy projects across biofuels. We've got a couple of guests here today, so I'd like to introduce them first before I get to the EcoEngineers team. First of all, we have Aaron Ratner with Cross River Infrastructure Partners. Aaron's an operating partner at Cross River, and their focus is on next generation circular economy projects. You want to give us a wave, Aaron? Hey, good to see you. Thanks for joining us today at Eco Insights. And then we also have a good friend, Max Verner with Live Oak Bank. Max is the vice president and head of bioenergy finance at Live Oak. Live Oak is one of the largest USDA lenders in the country, and they are an FDIC insured institute. And we'll hear from both of them in just a minute. Joining us from EcoEngineers is our very own Jim Ram, Roxby Hartley, Brad Plima, Natasha Bielstein, and Karen Jones. Thanks. With that, I'm going to just toss the first question out to Max, and the same question to Aaron. If you would, Max, tell us a little bit just of yourself, maybe whatever you'd like to say about Live Oak Bank, what you'd like for us to know about Live Oak, and then share observations or perspectives with us on how you've seen bioenergy lending change from where we were in Q4 2019 to where we are in almost the end of Q2 2020, Max.
Sure. Well, thanks guys for having me today. I appreciate the opportunity. It's good to see everyone again, given the situation. So to the first point, Live Oak is a specialty lender based in Wilmington, North Carolina, and we lend nationwide. Historically, we're a small business lender. We're actually the largest SBA lender in the US by volume of originations, and we're also the largest USDA rural development lender under their Renewable Energy for America program and their business and industry programs. Our project finance team focuses on energy and infrastructure for rural communities across the US, and I specifically focus on biogas. That includes anaerobic digestion, landfill gas. We've worked with some composting facilities, and we're looking to also segue into some smaller scale renewable biofuels. As far as the question about kind of what has changed, it's certainly been an interesting time. I think our project finance team has been fairly business as usual for the most part, which is probably a little counterintuitive. I think we've been a little more careful about the types of projects that we're looking at in terms of the hosts, that is the waste producers, and also the types of developers that we're working with, making sure that we are working on projects that have sort of the more traditional, well-rounded bankability to them. So I think coming out of COVID, we'll see a little bit of a restriction on available credit from banks. I think that's as to be expected. Most of the lenders in the country right now are focused on serving their own portfolios and making sure that their existing customer base can weather this storm. So we're going to be probably scrutinizing things like liquidity and other balance sheet ratios that we might not always consider in project finance. We're typically looking at projected cash flows instead of operating history. And I think we'll see that paradigm shift a little bit coming out of COVID, probably at least for the rest of 2020, maybe into 2021, depending on the industry. But again, for the most part, we're working with municipal wastewater treatment centers, which are fairly stable. We're working with landfills, again, very stable. Waste management is an essential service. And we're working with agricultural producers, which again, an essential service. And so we're not seeing a lot of disruptions in supply and demand for those particular types of facilities. I think we are seeing a little bit of disruption in the dairy industry, for example, and maybe in some of the meat processing facilities that are having to be shuttered temporarily just for precautionary measures. But again, aggregate waste production, we've not seen significant change, and we've not seen a significant decrease in the corresponding energy production. So I think overall things are pretty stable in our world.
Boy, thanks for that, Max. It's really nice to hear that there's some stability out there in the market. So appreciate that. Aaron, would you like to take a shot at that question?
Sure. Good morning. Thanks for having me. So just by way of background, I was a partner and head of origination at Ultra Capital for 4 years and spent a lot of time focusing on biogas and renewable natural gas. Before that, spent a few years at Generate Capital. So I've been in project finance now for over 7 years. I left Ultra earlier this year and joined Cross River as an operating partner. Cross River Infrastructure Partners is a development and commercialization firm that works with established developers and technology providers to help them accelerate their projects to market. We have a focus on the carbon economy, so we're working on a series of biogas projects, carbon capture projects, both repurposing for industrial use and livestock feed, and a series of advanced agriculture projects we're also in development on. And we work with our developer partners to help them get their projects ready for financing, get them financed, and then get them deployed. You know, when I think about the biogas space at the moment, where it is now compared to where it was at the end of last year, the end of 2019 was sort of the tail end of a gold rush for feedstock, which started when LCFS prices really picked up. And there was a period of time where developers were running around signing any feedstock agreement they could with counterparties just to try and lock up the supply without any time spent on the credit quality of the counterparty, which, as Max said, is becoming increasingly important. And that led to skewed expectations on the part of dairy farmers in particular around what they should expect for their contribution to these projects. And so that I think did a disservice to the market in a lot of ways. And it's become increasingly difficult as a result to count the number of biogas projects that have been successfully developed on time and on budget that are performing as expected. And in fact, the sector is littered with projects that have been idled or gone sideways or underperforming or in some form of litigation or have had development canceled. So the sector in many ways needed a bit of a scrubbing, and in that way there may be a silver lining here. But if you look at the deals that are getting done right now and worked on, you know, everybody has reason to be a bit more focused on the diligence, right? On the investor side, you know, the credit worthiness of the dairy provider or the livestock farmer has become increasingly important, and rightly so. These are not assets that you can move. Once you build a biogas project on an agriculture facility, whether it's manure or agriculture waste, it is almost impossible to move that facility for anything other than scrap metal prices. So the creditworthiness of counterparty is incredibly important. As well, the EPC market has been a bit disrupted by what's going on right now. And so while there are EPC firms out there who are willing to break ground on projects, pandemic happens to be part of a force majeure clause in almost any contract. And it's not only the EPC contractor you need to worry about, it's all of the sub-providers, down to the key equipment providers and the personnel involved to get these projects done on time and on scope and on budget. So there's a lot more diligence going into who is going to do the work than there might have been before. And then, of course, on the developer side, developers need to be asking their investors if they're still going to do the deal. You know, have their investment criteria changed? Has their investment process changed? Have their investors told them to be more cautious these days? And so everybody's being a little bit more cautious. And then, obviously, needless to say, the lack of ability to do site visits and get together in person is going to make it difficult for some of these projects to really cross the finish line and have those in-person meetings that help deals get done. But, you know, in all of that, there is a silver lining, particularly on the corporate side. As Max said, you know, there has been big disruption to some of the large operators in the food system, but the trend towards sustainability is secular. It's going to happen. All of the major companies are committed to it. And so they're taking this time, even though many of them are in some form of crisis, to really batten down and focus on what they can do to be sustainable now and make sure they emerge from this period having taken some of those initiatives in hand. So we're seeing a more opportunity now. We're seeing a lot more attention to it from the large corporations in the sector, and we think that over time that'll be encouraging.
That was a great way to wrap up Eco Insights episode 2, Equity, Finance, and Lending, with a wonderful overview provided by our friends from Live Oak Bank and Cross River. But please stay tuned. The conversation continued on with this group, and we have parts 2, 3, and 4 coming up.